How often do you carry out transactions through the bank? As a matter of fact, in recent times, people, individuals, or business organizations carry out transactions more often through the bank. Now, as a business organization, as you carry out transactions through the bank, either by paying for services or by receiving money for services rendered, you keep your own records. That's the CashBook. We've done that already. Remember, as you keep your record for the transactions you've done through the bank also keeps records on your behalf. So as you record payments made in your own book, the bank records outflow against you. Now, at the end of a particular period, the bank will normally send you a statement, and that statement will carry a balance after showing what you have deposited into your account and what you have withdrawn. Now, the balance that the bank statement is showing must be the same thing with the balance that your CashBook is showing. Now, it is very possible to have differences such that the bank statement sent to you by the bank is carrying another balance different from what your CashBook is showing. This will take us to reconciling the bank, and as such we'll be looking at what? Bank reconciliation statement. Now, defining a bank reconciliation statement, it's simple. Any statement prepared to agree or reconcile the difference between the CashBook balance and the bank statement balance is called the bank reconciliation statement. What am I trying to say? Remember, as you record your transactions through the bank also record transactions that you have done through them. What I'm saying is, you record yours in your book as an organization. The bank also record its own in a book against you as a customer. Now the bank sends you a bank statement showing your withdrawals and your deposits and the balance at the end of a particular period. That balance is expected to be the same thing with the balance that you have in your own record, which is your CashBook. Now, where there's a difference in the balance the bank statement is showing and the balance your CashBook is showing, there's a need to reconcile the differences. The statement that you prepare to reconcile the difference between the balance your CashBook is carrying and the balance your bank statement is carrying is what we call the bank reconciliation statement. Basically, the essence of the bank reconciliation statement is to update the CashBook or to bring the CashBook to the same balance that you have in your bank statements. Now we understand what bank reconciliation statement means. We must also know that it is not the same thing as bank statement. The bank statement is a statement that the bank sends to the customers, showing how the customer has operated its account at the end of a particular period. Now, the bank statement shows the customer's withdrawals, the customer's deposits, and the balance remaining after the withdrawals and what? Deposits. This is what we call the bank statement. It is not the same thing as the bank reconciliation statement. You must be able to tell the difference. The reconciliation statement is a statement prepared to agree the difference between the bank statement balance and the CashBook balance. While the bank statement is a statement sent by the bank to its customers, showing how the customer has operated his what? Account. So in a nutshell, it gives you the activities within that period. How much money entered your account, how much money left your account, and how much is remaining after the difference between what came into your account and what left your account. That statement sent to you by the bank is what called the bank what? Statement. Now, this is how a bank statement looks like. It is a statement received from one of the banks in Nigeria here, Guarantee Trust Bank. The customer's name here is Dosu Ajoda Jeremiah. As you can see, there's a detail of activities here. You can see the date of the print, the address of the customer, the currency, that's Naira, the period here, and then the opening balance. And then here's the detail we're looking at here. You can see the reminders description of the inflow or outflow. Here you see the transaction date, you see the transaction reference, you see the value date. And then here you see the debit. Debit here means what? Money leaving your account from the perspective of the bank. Credit here means money coming into the account from the perspective of the bank. And the balance here is different between what left the account and what came into the account on a particular day. So if you look at this, the opening balance here is 388,000 plus. Then the first outflow, which is debit here, is 20,000. If you take that out of the 388,000, you have 368,000 as the what? Balance. And then you have the description of the what? Of the payment or of the outflow. A deposit for PMS purchases, ECHED. So this is typically how a bank statement looks like. So the bank will send you something like this, showing the money that left your account, which is usually debit. Some bank use withdrawals. And then money that came into the account, which is usually what? Credit. Some bank use deposits. And then we have the balance as at the end of the period. So this is a bank statement. So what we are saying is, at the end of the period, this is saying 1st of March. Let's assume this is the end of the period. The balance here is 348,314.20. It is expected that this balance is what you should have in your own cash book as a business organization. If this balance is not agreeing with the one in your cash book, you prepare bank reconciliation statement. Now we're going to be looking at the causes of discrepancies. When I say causes of discrepancies, I mean the reason for the difference between the bank statement balance and the cash book balance, or better still, factors that can cause the bank statement balance not to agree with the cash book balance. Remember, I said you record from your own perspective in the cash book. The bank also does its own record. So basically, if you're debiting here in your own cash book, the bank will credit. If you're crediting in your cash book, the bank will what? Debit. That's the way it flows. But then there can be what? Differences in the balance due to some reasons. And that's what we're looking at. The first one here is unpresented checks or undebited values. Now, what are unpresented checks? Unpresented checks are checks that have not cleared as at the time of reconciliation. What I'm saying is you gave some checks to suppliers. It's expected for the supplier to take the check to where? To the bank for withdrawal. Now, when you give out that check, you would have credited your what? Your cash book as an outflow in your bank column. It's now left for the supplier to go to the bank and do the withdrawal so that the bank can debit you there from their perspective. It is possible that as at the time you received your bank statement for the period, that supplier had not gone to present the check for withdrawal. So what I'm saying is that value would not have been debited to your what? Bank statement, but you would have captured it in your cash book as an outflow, which is credit. So you see, your cash book has been credited. Remember, in our cash book, when we make payment to credit, when we receive money, we debit. So as you credit your cash book, the bank does what? Debits you there for the money to leave. But where you have credited your cash book with the check issued to the supplier, expecting the supplier to what? To go to the bank for withdrawal. As at the time you got the bank statement, the supplier had not presented the check for what? For withdrawal. So it means that what? That value on the check will not have what? Reflected in your bank statement as at when you are what? Reconciling, if it has not been what? Presented. So we call those what? Kind of what? Transactions, those kind of items, unpresented what? Checks. Basically, we say unpresented checks are what? Values that have been credited to the cash book but have not yet reflected in the what? Bank what? Statement as what? As a debit. The next factor that can cause a discrepancy is what we call the uncredited checks or uncredited values. Now, uncredited checks are checks received from customers or clients that has not yet been reflected or credited to the bank statement as at when the reconciliation is being carried out. What I'm saying is, it is possible for the organization to have received a check. Remember, when we receive check, we debit to our cash book, and then we are expected to present the check to the bank for withdrawal as well. So in that case, the check goes through the clearing system and then is credited towards our account if it is two different banks. But if it's the same bank, it hits the account immediately. But now let's say that it's different banks that will go through the clearing system. It will take some days, like 2-3 days, for it to hit the account. Now it is possible that that check would not have cleared as at the time of reconciliation. So we would have captured the received check in our cash book as a receipt, that's debit, expecting it to clear and then settle down in our bank account as well as a credit. Now it is possible that as at the time of reconciliation, the value on the receipt check will not have what? Reflected in the bank what? Statement. So that is what we call uncredited what? Checks. So the idea is that in the cash book it has been debited, but it is yet to be credited to what? Our bank account. So any value that has been debited to our what? Cash book, but as at the time of reconciliation is yet to be credited to our bank account, is what we call uncredited checks or uncredited values. Now another factor or another reason for discrepancy can be standing orders. Now a standing order is an order given to the bank or an instruction given to the bank to make or carry out some transactions on the customer's behalf. So you can give your bank an instruction maybe to pay your subscription on a monthly basis, or maybe to pay your washerman on work a monthly basis. So the idea is that the bank has that instruction and would not have to contact you before carrying out some transaction. So sometimes it is possible that the bank would have carried out the transaction and you will not know until you what? You collect the bank what? Statement. So in that case, the item would have appeared in your bank statement, but it will not appear in your cash book. Remember, it's a payment that's supposed to be credited to your cash book. So it is not credited to your cash book because you're not aware. But when you got the bank statement, you're seeing it as a debit in your bank what? Account. So that can cause what? A difference between the cash book balance and the bank statement what? Balance. Standing order. That's an order given to the bank or an instruction given to the bank to carry out some transaction on the business's what? Behalf. So you don't get to know until you get the bank statement. And as such, it will be in the bank statement, it will not be in the what? Cash book, and can cause what? a difference or a discrepancy. Another factor that can cause discrepancy here is what we call the direct credits. Direct credits are values that are paid directly into your what? Bank account. You can have some clients or some customers paid directly into your what? Bank account. So you don't get to know until you check the bank account or until you collect the bank what? Statement. So it is possible that at the time of reconciliation, some money would have what? Entered your account directly as a credit, but you are not aware to put it in your cash book as a debit. So in that case, it will cause what? A discrepancy between the cash book balance and the bank statement what? Balance. Now another factor here is what we call dishonored checks or returned checks. Now what's a dishonored check? A dishonored check is a check that the bank has returned due to some reasons. For instance, maybe the signature is irregular, or the money in the account is not enough, or it is stale, or that's past the period of 6 months, depending on the country. Nigeria is 6 months. But what we're saying here is that or the business organization issued a check to what? A supplier or an individual, but when the individual went to the bank refused to pay that individual for somewhat reasons, and then referred that check back to the person that issued it. So now it is possible that at the time of reconciliation, you would have credited your cash book with the check issued, and now this man here went to the bank, and the bank returned the what? Check. So if the check is returned, it will not reflect in your bank what? Statement. So your cash book will be capturing it as a payment, but the bank will not debit you because it is returned. So that can cause a difference or a discrepancy between the cash book balance and the bank statement balance. The next one here is bank charges, bank commissions, or direct debits. Usually the bank will charge you for some services rendered on your behalf, maybe for maintaining your account, and then they will debit you periodically, and you don't get to know the value until you get the bank statement. So it is possible that you have such a direct debit that you will not capture in your cash book as at the time of reconciliation. So you will be seeing it in your bank statement, but it will not be reflecting in your cash book. So that can cause what? A discrepancy. So basically, any debited item directly to your bank account that you are now aware of will not reflect in your cash book. So that can cause what? A discrepancy between the balance in the bank statement and the balance in the cash book. Now, how do we prepare the reconciliation statements? Under examination condition, you will be asked to prepare the adjusted cash book before preparing the bank reconciliation statement. So we can say bank reconciliation statement after adjusting the cash book. Okay, and then we have the bank reconciliation statement without adjusting the cash book. But let's look at bank reconciliation statement after adjusting the cash book. Now, this approach, the reconciliation statement is prepared after adjusting or updating the cash book with items appearing in the bank statement that did not appear in the what? Cash book. What I'm saying is, you look at the bank statement. Any item that is in the bank statement that is not in the cash book before receiving the bank statement will now be what? Entered in the what? Cash book. That's what we call adjusted cash book. So it's like making the cash book reflect item that has not been reflected. Now we call the so you have to adjust the cash book before you now prepare the bank reconciliation statement. So that we call bank reconciliation statement after adjusting the what? Cash book. Now this illustration shows how a bank reconciliation is prepared after adjusting the cash book. Now, as you can see, we have this question here. It said the following is the bank column of the cash book of Clean Ventures Limited and the bank statement for the month of March 2020. You are to adjust the cash book and prepare the bank reconciliation statement as at that date. Now, this is the cash book and this is the bank statement. So we're going to use this information now to adjust the cash book and then prepare the bank reconciliation statement. You capture all this. Now, as you can see, this is the cash book, your normal cash book, the bank column basically. Remember in your cash book, when we make payments, we credit, and when we receive payment, debit. Now, understand the simple concept here. Whenever you're crediting your cash book, the bank debits you. Whenever you're debiting your cash book, the bank credits you. So that is the expectation. When you debit your cash book, it's expected that the bank should credit your bank account. When you credit your cash book, it's expected that the bank should debit your bank account. Now, you collect your bank statement, you have to compare it with your your cash book, to see that everything captured in the cash book is captured in the bank statement, and everything captured in the bank statement is captured in the cash book. So having established that fact, so we cannot go ahead to adjust the cash book before preparing the bank reconciliation statement. Now, remember I said whatever you credit to your cash book is expected to be debited in your bank statement. Whatever you debit in your cash book is expected to credited in your bank statement. So it means that any item in the credit side of your bank statement is expected to be in the debit side of your cash book. Any item in the debit side of your bank statement is expected to be in the credit side of your cash book. So for you to adjust the cash book, you have to look for items in the credit side of the bank statement that are not in the debit side of the cash book. So when you locate those items, put them in the debit side of the adjusted cash book. Then you now look at items in the debit side of the bank statement that are not in the credit side of the cash book. When you locate those items, put them in the credit side of the adjusted cash book. Simple. That is what is required to adjust the cash book. So let's go. Look at your cash book in the question. It has a debit balance of 436 now. Remember, I told you, I said a debit balance means that the debit side is more than the credit side. A credit balance means the credit side is more than the debit side. So this cash book has a debit balance because the debit side is higher than the credit side by 436. That's why you're having balance brought down here at the debit side. So it is the balance brought down that we want to know. If your balance carried down is in the credit side, then the brought down comes to the debit side. So wherever the balance brought down is, determines if it's a debit balance or a credit balance. So the balance brought down here is in the debit side. So it means that your cash book has a debit balance. So you open your adjusted cash book. As you can see, adjusted cash book. Balance brought forward 436,900. That's the debit side. Remember, that is what you have as they brought down in the question here, 436,900. So balance brought forward 436,900, adjusted cash book. Can you see that? So now we'll come back to the question. Remember, I said for us to adjust the cash book, we must locate items that are in the bank statement that are not in the cash book. So let's start. Come to your bank statement here. Let's do the credit side first. In the credit side, we have 1,300,000 in the bank statement. It's expected to be in the debit side of the cash book. So we'll go back. Is it there? It's there. So we don't have issues with that. That cannot cause a discrepancy. The next one is 200,000 in the credit side here. So we'll check, is it in the debit side of the cash book? It is there. So that cannot cause a discrepancy. The next one is 70,000. Is there 70,000 in the debit side of the cash book? No. So this can cause a discrepancy. So what is the transaction? It says dividends. So apparently there's a direct credit that the business is not aware of. Maybe a company that they have share in pay dividends to their account directly. So we have a direct credit here, which is 70,000. Okay, that is not in the debit side of the cash. So because it is in credit of the bank statement, it has to come to where the debit side of the what? Cash book. So we adjust the cash book. We come here, we say dividends, debit side 70,000. The next item here is 295,000. Is it in the debit side of the cash book? No. You can cause a discrepancy. So what is against it? Carlo Limited. So Carlo Limited paid directly into the account without them knowing. So if it's in the credit side, it should be in the debit side of the what? Cash book. So because it's not here, so we have to put it in the adjusted cash book now. So we have debit side 295. What do you have? Carlo Limited. Okay, so let's come to the bank statement now. Is there another thing here that we've not picked? No. So we are through with the credit side now. So let's come to the debit side of the bank statement. Whatever is in the debit side here must be in the credit side of the what? Of the cash book. So let's go. 350 is in the debit side. Is it in the credit side? Yes. So it can cause a discrepancy. 50,000 is in the debit side. Is it in the credit side here? No. So that can cause a discrepancy. What is it? Subscription paid on order. So there was a standing order for subscription that the bank paid that was not in the cash. So if it's in the debit side, that should be in the what? Credit side. So we'll go to what? Adjusted cash book. Credited 50,000. What's that? Subscription. Okay. The next item here is 323,100. In the cash book, yes. So that cannot cause what? Can't cause a discrepancy. Are you with me? I want to believe so. So we'll leave that. The next one is 25,000. In the debit side of the bank statement. Is it in the credit side? No. So that can cause what? The discrepancy. So we adjust the cash book. What do you have there? Account maintenance charges. So the bank has debited us with what? Account maintenance of 25,000. It also be in the credit side. So we come to adjusted cash book 25,000. What do you have? Bank charges. The next item there says VAT on maintenance charges 1875. Is it in the credit side of the cash book? No. That can cause discrepancy. So we'll take it to adjusted cash book. Bank charges 1875. I think that's the last item there. So we'll balance the adjusted cash book. The debit side here is higher. When you add everything here, okay, and you minus everything here, whatever you get is the balance. So we have the total here higher than the what? Credit here by 725025. That's the balance carry down you have here. So it comes here as what? Balance brought down in the debit side. Okay, I'll say that again. This balance carry down you see here is the difference between the total items in the debit side and the total items in the credit side. That's what you have as balance carry down. That is what is balance brought down here. So this balance is what we take to what now? To the bank reconciliation statement. So as you can see here, we have bank reconciliation statement as at 31st March 2020. So we have balance as per adjusted cash book 725025. Okay, remember we have used items in the bank statement that are not in the cash book to adjust the cash book. Now we're going to use items in the cash book that are not in the bank statement to prepare the bank reconciliation statement. So now we've taken the balance as per adjusted cash book at 725025. We got it from here. So we'll now go back to what? Our cash book. Remember, anything we debit here should be credited to the bank statement, and anything we credit in the cash book here should be debited to the bank statement. So we have already clarified items in the statement that are not in the cash book. Now let's clarify items in the cash book that are not in the bank statement. So the first one here, let's do the debits here, or we can do the credits. Okay, so let's go. We have 350 in the credit side. It's expected to be in the debit side. It's there, so it can cause an issue. Okay, we have 280 in the credit side of the bank account. It's expected to be in the debit side here. Is it there? No. So this item is what we call undebited values or unpresented checks. Remember, You gave out the money, the check, but it has not gone through the bank as when you're reconciling. So it's in the cash book as an outflow, but the bank has not yet debited you. So that's what you have here. So what is it? Office furniture. We bought office furniture. We gave a check of 280,000, but the guy has not gone to the bank to collect it. So that's an unpresented check. So we come here. We say add unpresented checks. Office furniture 280. So the next item here, we've done 350, we've done 280 now, is 480,000. 480,000 here is credited in the cash book. It is expected to be debited in the bank statement. So we'll go and check. Is it there? It's not there. So you can cause a reconciliation. So what's against it? We made some purchases. Okay? So it's also an unpresented check or undebited values. Items are paid in the credit side that are not in the debit of what? The bank statement. They are unpresented checks or undebited values. So we'll go. It's part of unpresented checks. Purchases how much? 480,000. So let's go. Is there any other one? We've done 480. 323 is in the credit side. Is it there? Yes. So that is about all the what? Items. So that means we have two unpresented checks items. So we'll go to our bank statement or bank reconciliation statement. We add 280 plus 480. That gives us 760,000. Remember, we are adding unpresented checks. So 280 plus 487. So 760 plus 725,025 gives us 1,485,025. So we've done items in the credit of the cash book that are not in the debit of the bank statement. So let's do items in the debit of the cash book that are not in the credit of the what? Bank statement. Those are the uncredited items or uncredited values or uncredited checks. So we have 1.3 here. Is it here? Yes. We have 200,000 here in the debit side of the cash book. Is it there? Yes. We have 270,000 in the debit side of the cash book. Is it in the credit side of the bank statement? No. So this 370,000 is what? An uncredited check. So we have received